Hello class, and welcome to the video lecture for Accounting for Property, Plant, Equipment, and Intangible Assets. Learning Unit 2 explains the calculation of depreciation expense using different methods. Depreciation is the method used to allocate the cost of an asset over its useful life. It's an example of the matching principle, which says expenses are recorded in the period incurred and revenues are recorded in the period earned. If a business has a piece of equipment that will last 15 years, the business will use that equipment to make money, to earn revenue. Over that time, the business needs to record the associated expense with earning that revenue. Since there's no way to know exactly how much an asset has depreciated each year, the accounting profession has developed methods to be used. A business should choose the method that most closely matches the expense associated with using a machine. Three common methods are called straight line, units of production, and double declining balance. Before you can calculate depreciation, you need to have an estimate of an asset's useful life. This is a best guess as to how long the asset will be useful. You also need to know the asset's residual value. Residual value is the value of the asset after its useful life is over. For example, let's say you buy a delivery van. You expect the delivery van will last 7 years before you have to replace it, and when the 7 years are up, it will be worth $1,000. This doesn't mean you can't keep the delivery van after 7 years. These are estimates only. Let's talk about the steps involved in calculating depreciation. The first step is to calculate the cost. We covered that in Learning Unit 1. The second step is to determine the asset's useful life. It may be in terms of years or units. An example of using units is miles. For example, the delivery truck may have an useful life of 90,000 miles. The third step is to determine residual value. Residual value is often 0. The fourth and final step is to choose a depreciation method. Let's look at the example in the textbook on page 594. So, Melvin Company purchased a truck on January 1st for $20,000. The residual value is $2,000. The truck has an useful life of 5 years. Let's assume Melvin Company chooses the straight line method of depreciation. The formula for straight line is the cost minus the residual value, all divided by the useful life in terms of years. This will give you depreciation expense of $3,600 per year. But what if you recorded your depreciation every month? In that case, you would need to divide 3,600 by 12 months. Let's review how to record this transaction, which you would have learned in Accounting 110. So, we debit depreciation expense for $3,600. And we credit accumulated depreciation for $3,600. Remember that accumulated depreciation is a contra asset account shown right under the asset account on the balance sheet. The book value of an asset is its cost minus accumulated depreciation. Now let's calculate depreciation if, instead of 5 years, the useful life of the truck is 90,000 miles. When you use the units of production method of depreciation, you first find the depreciation per unit. The formula for depreciation per unit is cost minus residual value, all divided by the total units of production. In this case, we get 20 cents per mile. Now we use that 20 cents per mile and multiply by the number of miles driven in that year in order to get the depreciation expense for the year. In year 1, The truck was driven 30,000 miles. We see that here in the third column, titled Miles Driven in a Year. So 30,000 miles times 20 cents per mile is $6,000. So $6,000 is our depreciation expense for year one. The next year, the truck was driven 21,000 miles. 21,000 times 20 cents is $4,200, which is our depreciation expense for year two. You continue on with this calculation every year until the book value of the truck has reached its residual value of $2,000. At this point, it can't be depreciated anymore and is considered fully depreciated. This doesn't mean the business can't still use the truck. It just means it can't record any more depreciation expense in its accounting records. Now let's look at the double declining balance method. To use the declining balance method, you must calculate a rate, which is a percentage. The formula to calculate the rate is 100% divided by the useful life in years multiplied by 2. At the end of each year, this rate is multiplied by the book value of the asset from the beginning of the year. Residual value is not deducted from cost in the calculations. Let's calculate the rate for the truck used as an example in the textbook. So the useful life was 5 years. So we have 100% divided by 5 times 2, which if you were to plug that into a calculator equals 40%. Now remember, 40% can be written as 0.40. Now we'll use the rate to prepare this chart. This chart is called a depreciation schedule. A chart like this is often created when an asset is purchased, so the accountant knows how much depreciation expense to record every year for that asset. So at the end of year one, we're ready to record depreciation expense. We take the rate we calculated, which was 40%, and multiply it by the book value from the beginning of the year. Since we just bought it that year, the book value is $20,000. 20,000 times 40% is 8,000. This is what we record as a debit to depreciation expense and a credit to accumulated depreciation. Now our book value is 20,000 minus 8,000, which is $12,000. Moving on to the next year, again we multiply the rate times the book value at the beginning of the year. The rate is still 40%, but the book value is now $12,000. See that in the fourth column, titled Book Value Beginning of Year, which is the cost minus accumulated depreciation. So 12,000 times 40% is equal to $4,800. And that's our depreciation expense that we debit, and we credit accumulated depreciation. Remember that accumulated depreciation isn't closed out at the end of the year because it's a permanent account. It gets bigger every year. Now accumulated depreciation has grown to $12,800, and our book value is reduced to $7,200. See the end of the year book value column on the far right side. So you continue on this way until the truck is depreciated down to its residual value of $2,000. You can't depreciate farther than that. The end of the Learning Unit 2 is about calculating depreciation for only part of a year. We don't calculate depreciation in terms of days. That's just too complicated for something that's only an estimate to begin with. Instead, we round off to the nearest month. If an asset is purchased on or before the 15th day of the month, depreciation is calculated for the whole month. If the asset is purchased on the 16th or after, ignore the month. Let's look at an example which is at the top of page 596. Melvin Company buys a truck for $20,000 with a residual value of $2,000 and an useful life of 5 years. When we calculated this at the beginning of the learning unit, we got a yearly depreciation expense of $3,600. If the truck was purchased on May 4th instead of January 1st, we only have a partial year. To be precise, we have 8 months out of the 12 months in a year because we count May through December. To find the depreciation for 8 months out of the year, we multiply the yearly amount by 8 divided by 12, which equals $2,400. If we use the units of production method, time doesn't matter because our expense amount is not based on time. It's based on units. If we use the double declining balance method, we do the same thing we did for the straight line method. We multiply the yearly amount by 8 divided by 12. So that wraps up Learning Unit 2. So I strongly encourage you to practice these calculations because I promise you will be asked to calculate straight line, units of production, and double declining balance depreciation on the next exam.